Today I'm going to show you how to make trades like a pro using the Robinhood app. If you're new here, I'm Jamie. I've been a pro trader for over 20 years, and one of the most common questions I'm asked, aside from how the markets are doing, is how to make better trades. While there's no trade type that fits all, I'll show you exactly how each order type works, what order type to use, and when to use it. When you're done watching this video, you'll be able to use any Robinhood order type like a pro. I'm assuming that you have some experience navigating the Robinhood app, so I'm not going to go into that in this video, but I will be showing you every step on screen so you can easily do it yourself. What you see is Robinhood on the right at their website, and on the left you see my iPhone with the Robinhood app opened, with the 100 most popular stocks sorted by the highest price. Now, I'm going to go over regular market hours first. With Robinhood, that matches everybody else because there are just regular market hours at 9:30 a.m. to 4 p.m. Eastern Time. Pre-market, you're going to have 9 a.m. to 9:30, and after hours, 4 p.m. to 6 p.m. Now, the majority of you who are investors, you're probably just using Robinhood just for that. Now, there may be some Robinhood traders in there. I would suggest don't use it for day trading to make a profit. You really should be using something different like Interactive Brokers, TradeStation, some other pro-level platform, because Robinhood is just really not set up to be a profitable day trading platform. If you're an investor, those are the hours that you could trade. You really want to stay away from pre and post hour trading because there's just no real advantage you have there. The spreads are larger. In fact, let's go down the screen and I'll show you a whole lot of reasons not to do it. Here they say, keep in mind, there's a risk of lower liquidity, which is true, risk of higher volatility, risk of changing prices, unlinked markets, news announcements like earnings, and some bad news coming out of nowhere, someone's getting sued. There's a guarantee the risk of wider spreads is going to be there, along with these other things like higher volatility, lower liquidity. You just don't really want to be involved in that unless you're a trader. And even when you're a trader, you really don't need to be in the aftermarket because it's just so risky as compared to what you get during the regular trading hours. Something important to note is that extended hours, right down here, trading order types and expiration settings, you may place only unconditional limit orders and typical Robinhood financial market orders. So what that's telling you is that you're going to be limited to just the limit orders and just market order based on what we discussed up here, which kind of limits what you can do with it. But like I said before, you really shouldn't be trading in those hours anyways. So going on to stop orders. Stop orders, well, they say that they won't execute during the extended hours session. That's true. With other brokers, that's not true. But with Robinhood, the stop limit and stop loss orders you place during extended hours, they're just going to be queued up for the market open at the next trading day. So the stop orders pretty much are just limited to the regular trading hours, not the extended hours. Trailing stop orders will not execute during extended hours session, and the trailing stop orders you place during those hours will be queued up for the next opening day. So just keep that in mind. Now, something that you should be aware of is time and force. When you place trades, you want to know, okay, when I make this trade, do I want that trade to go off today? And if it doesn't go off today and get filled, well, do I just want it to be automatically canceled, or do I want to carry it into the next day and the next day and all the way up to 90 days? If you don't want it to last longer than a day, don't worry about it. They're going to default to good for day, GFD. That's just going to work for you for that day. No matter what your order is, if it doesn't get filled, it will be canceled, and you can then start trading the next day, clean slate with that order gone. So as you can see, it automatically expires at the end of the extended hours session. If you put a trade in there, good for the day, which is the default, like I said, it will not expire until 6 p.m., which is all the way into the later sessions. I personally would cancel it as soon as 4 p.m. rolled around because the market can get very volatile, the spreads are wide, and you probably don't want to get filled at that price on some wild order that comes through in aftermarket trading. You just don't want to do that. So it's best usually to wait until the next day and get a fresh new order out there. The good till canceled, or GTC order type, is good for the pre-market day or extended hour session, but it actually will last without you touching it up to 90 days. So if you want to buy, let's say Microsoft at 150, it's going to sit there as long as you mark it as a time and force of good till canceled. It'll sit there for 90 days until it hits that price. And if it doesn't hit the price, you don't get filled. If you hit the price, well then boom, you got filled, then the rest is history. But you definitely want to keep in mind all of these things that you see here on the screen when it comes to trading out of regular trading hours. It's not for the average Joe. You just want to be trading during the regular hours and keep it simple. Now, there's going to be stocks that you might be interested in buying that you just quite frankly don't have enough money to buy one whole share of, and that's what's called fractional shares. Now, that's something that is a recent thing to Robinhood, but it's been around for a while with other brokers. But let's go down to the fractional shares section and go over that real quick. Essentially, fractional shares allows you to piece or a fraction of a stock if you don't have enough money to buy one full share. And that's pretty cool, because if you want to buy some Amazon, Tesla, Google, any of these high-priced stocks, well, you just couldn't do it unless you had one full share. So in the example of Amazon, you'd need $3,200 just for one share. Well, if you like Amazon so much and you want to participate in any upside that it might have from this point on, but you don't have the $3,200 to spare, fractional shares is for you. You just go in there and put a buy order and you buy fractional shares and you're in. You could buy for as little as $1. That's what's really cool about that. I really like fractional shares for those people that want to participate in those larger price stocks that just don't have enough money to get into those stocks at all just because it's too much money to start with. Well, this is a great way to do it. So that's about all I'll say about fractional shares, other than the fact that when you want to take your fractional shares, let's say you have Robinhood and then you decide to go to M1 or Webull or Interactive or whomever, you cannot take those fractional shares with you. They are your shares, but what you're going to have to do, as I mentioned in another video about this fractional share situation, is you're going to either have to leave them there, which is no big deal, or you're going to have to sell those fractional shares and then take those funds and then transfer it to your other broker. That's how you're going to have to do that. Also, another thing to note is that fractional shares, you don't have access to limit orders or conditional type orders. You can only do dollar amount or share amount orders, which are market orders. And you can only use them good for day. You cannot use them for extended hours, as they note right here. Okay, so let's get into the stuff you really came here for, and that is how do you place an order and what type of order type do you want to use and what's the time and force you should use. There's many reasons why you should use one or the other, but let's go ahead and do some real world scenarios so you can understand how it might work. On the left hand of your screen, you're going to see a list, and the very top one is Amazon. So you just click on Amazon. You see the line chart there. You can see the activity and stats, the news. You can also get analyst ratings, earnings. I mean, there's just most of the simple stuff right there at your fingertips. I think that's great. I really like the app for that. It makes it simple for everyone. When it comes to order types and how you're going to buy this Amazon, well, it really depends on what kind of price you want and how much money you have. So in this case, let's say $32.03 is the closing price of Amazon, and I want to go ahead and buy some right here, right now. Now, I'm filming this video on a weekend, so the markets are closed. And something to note, the Robinhood app on my iPhone, I just use it for news and stock quotes. All of my money is in Interactive Brokers and TradeStation, where I trade futures, options, stocks, ETFs. So I have very little in this account, just so you know ahead of time, so you can understand why I'm not going to be doing certain levels of buying, because I just don't leave enough money in here and I don't trade whatsoever with this account. So I just use this as a quick way to get news and price right out of my pocket, whereas my other apps from Interactive Brokers takes a few more swipes of windows to see what I want to see, but with Robinhood app, it's a little quicker. So I just use it for that. But for the majority of you, this is an excellent app to use because you're going to be investing, you're going to be doing dividend investing, maybe a few trades here and there, maybe even some crypto, which I won't talk about in this video. It's a great app. I really like the way it functions and I like the user interface, but let's go ahead and show you how to do a buy on Amazon. At the bottom right hand of your screen, you just click the green button, buy. Now you're going to come up with another screen, and something I want you to note at the very bottom left of this screen is a decimal, and you're going to see why shortly, why I mentioned that. But go ahead and look up the right hand corner. You see that thing that says shares. So you click that, and now you're into the type of orders that you can use when you're wanting to buy Amazon. And in this case, let's say you want to buy Amazon at market. So if you do that, you're going to be using these two types at the top called buy in dollars and buy in shares. So one thing I will say about investing investing is you really should not be thinking about how many shares you should be buying, because when you and I transact, or you go transact at a store, they don't say, well, how many shares do you have in your bank account, or how many shares do you have in your wallet? They want to know how many dollars you have in order to buy that ticket item, right? Well, the same thing here. When you buy stock, you don't want to just buy 100 shares, 10 shares, 20 shares, because each stock has a different price and it represents a different dollar value. So in this case, I highly recommend just going into buying in dollars. Let me give you an example. Let's say you got $10,000 in your account and you want to spread it equally among 10 different stocks. So what does that mean? That means you're going to take $1,000 and invest it in 10 different stocks. So you're not going to want to take that $1,000 and pick up a calculator and figure out, okay, how many shares of XYZ stock do I need to buy in order to get $1,000? No, this is much easier. You just go in for dollars, and as you can see, it looks like a calculator at the bottom. Let's buy $5 worth of Amazon. Okay, $5, you punch the 5 in, and then you go review. Now, at the bottom, you see this order summary, and it says you're going to buy $5 worth of Amazon based on the current price of this. You'll receive approximately so many shares and decimal points, and then they're going to place it after the market opens and execute it at the best available price. Since I'm shooting this video on a weekend, that means come Monday morning, 9:30 a.m. Eastern Time, you are going to be sent out on the market with 0.001561 shares to buy $5 worth of Amazon. So let's go ahead and do that. We swipe up. Bingo. Now you see that your order is queued up. You're going to put $5 into it and it shows the shares again. And why don't we go ahead and view the order? And you can see here when it's going to be executed, 9:30 come Monday. You're queued up as the order status. Today is July 11th is when you submitted the order. Time in force, remember, good for day. That means that come Monday morning, that order is only going to be good for the day. Well, it really doesn't matter because it's going to be sent out on the market immediately with a dollar order, which is a market order for $5. So let's go ahead and cancel that order because you know what? I really want to double down and I want to get $10 into that Amazon order. So let's cancel the order. You press cancel at the bottom of the screen, shows you a message. It shows canceled. Click the X at the top left hand of the corner. And now you look at the bottom of your screen, you see this red dot on messages. You've got a message from that order and you read it and you see that your order for $5 to buy Amazon was canceled. And if you forgot that you did that or something, you can always click on this. Let me take a look at the order and it shows that it was canceled for good for day, time in force entered for $5. You get the point. Let's go into buy in shares. You don't know the share amount you're going to want to buy, but hey, let's take a stab at it. Let's put a decimal point and put 0005. Okay, so I don't know how much. Oh, it's going to cost you 16 cents. So as you can see, the estimated cost comes up to 16 cents. Well, what if I were to take a few decimals and put a 5 there? Oh, now it's going to cost me $16.02 if I want 0.005 shares. So that's pretty cool. It does the math for you right on the spot, but really that's kind of a backwards way of doing things. I mean, I seriously don't know why they do that, but knock yourself out if that's the way you want to put it in. I say we go with buy in dollars. And like I said before, the $5 order to be executed Monday, we canceled that. So I want to buy $10 and let's do it. Now you see the order at the bottom summary. Let's swipe up and bingo. Now you see the new $10 order and I say done. Let's go into messages and now you see your Amazon order and it says this order will be filled. Okay, so you see the summary again and you want to see more details. So you just click this down below. View that order and you see right there it's queued up for Monday morning and it's $10. I'm going to go ahead and cancel that one and we're going to go back. And so you can see how the buy dollars works. That's the way I suggest that you do it. Just go in there with buy how many dollars worth. It doesn't matter how many shares. I mean, really, if you're being very good with your risk management and what stocks you want to buy and how much of each, you're not going to care about how many shares of each you're buying. You care about how many dollars you have invested as it is relative to the amount of capital you have, and that's called risk management. You don't want to be going in there with 100 shares of this, 50 shares of that, just willy-nilly thinking that you have good risk management because you probably don't. In fact, I know you don't because it's not based on any kind of relative dollar amount, and that's what you should be basing it on. Now let's go ahead and look at the other conditional orders. Okay, so I just showed you how to buy something using a buy in dollars or buy in shares. We'll go to conditional orders. I'm going to click on a limit order. Okay, so limit price, let's say I want to buy Amazon at 3,000. I want to do 3,000. And I want to do it during market hours. Of course, I'm forced to do that if I just use fractional shares. And I want to make it good until the close of Monday at 4 p.m. Press continue. And notice something right here. Look at the bottom left-hand corner. You do not see that decimal point. What does that mean? That means they do not allow fractional shares to be bought or sold using conditional orders. Can't put anything less than 1. 1 equals 1 whole share. So if I try to put in a fractional share amount, well, guess what? That decimal is missing. I can't use that. GSAT. And let's go into that. So let's go ahead and buy. Let's go into conditional orders. Let's do a limit order, and I say, hey, I want to buy this at 30 cents. That's the price I'm willing to buy it at. And a limit order, like we discussed before, means that that is the price or better. So I want to buy it at 30 cents or less. And if it hits that price, it will fill me as long as there's enough shares that are traded at that price or better and fill my order. So I'm going to press continue, and I'm going to do it during market hours till 4 p.m. is the time in force of Monday. And now it's asking how many shares. Now you see the decimal point is missing again. They do not allow fractional shares. So I'm going to say I want to buy 100 shares. So that means 100 shares at 30 cents. If price goes down there, I will get filled or at least executed, and I will not 100% get filled unless enough shares traded at that price. Now let's swipe up to get that order. There you go, 30 bucks. Let's view the order. It's queued up for Monday. Put the order in today. Good for the day, Monday until 4 p.m. And I'm going to buy 100 shares, possibly at 30-cent limit price or better. So let's go into messages, and there you see that I've got Global Star, and it shows that they received the order for 100 shares at a maximum of 30 cents per share, which is a limit order. So if it trades at 31 and above all day till 4 p.m., I will never get filled, and my order, because it's a limit order that is only good for the day, it will cancel as of 4 p.m. and I won't buy that stock unless it goes down to that 30-cent level. So I am going to cancel by pressing the bottom button. Let's view that it's been done. Yep, it's canceled for Monday, 100 shares, and I am done with that one. Let's go ahead and try a buy. And we're going to use a trailing stop order. And as you can see, it says trigger a market buy order if GSAT rises above its lowest price by, and I'm going to give it a percentage amount, let's say 2%. So the initial stop price is going to be 36 cents and the market price is 37 cents. So let's go ahead and continue. I'm going to leave it time in force for just the day, Monday at 4 p.m. It will cancel if it doesn't get filled. I just have to give it how many shares. I want 10 shares. Swipe up. Order received. It's going to cost me $3.77 because it's free commissions, and I'm done. But you know what? I don't want that order to go through, so let me cancel it again, and it's done. All right, let me go ahead and show you a stop order. A stop order is going to trigger a market buy order if it rises to the stop price. So let me put a price of 40, and you can see Monday till 4 p.m. And then if I don't get filled, it cancels, and let's say 5 shares. So my stop price is 40 cents. It's going to cost me $2 if it goes there and I get filled. And rinse and repeat. All right, let's go ahead and cancel that. All right, now let's go over the stop limit order. As you can see on the screen, now this is an odd way to do it, but they're setting a fixed stop price above the current price of GSAT, and a limit buy order is then triggered below that price. So essentially that means that when that price, let's say it's trading at 30 cents and it goes to a stop price of 40 cents. Well, I'm basically trying to play a breakout above 40 cents, but I want to buy it lower, if that makes any sense. So if you could see on your screen, it shows the stock price currently trading down at whatever that level is, and we'll just call it 30 cents. And then if price, and I mean if price can get to my stop price of 40 cents during the day, Monday, it will then trigger my limit price to become active, but it's saying, hey, it reached 40, but I don't want to buy it up there. I want to wait till it comes down to my limit price. So this is the type of stop limit order you would use to essentially do a buy limit. You want to go ahead and play the momentum price of a stock. And if it has momentum, you're willing to buy it, but you don't want to pay up for it. You want to wait for a pullback. And then if it gets to your limit price or better, you want to buy it. That's essentially what this picture is showing you here. Okay, there's many different kind of stop limit orders you can place, but that's the one they're showing you on the screen right now. I'll put 40 cents for the trigger price. Basically, that is the stop price or the line in the sand that price must meet in order for my limit order to become live into the marketplace for me to buy, but I will not buy unless it's 40 cents or less. And in this case, I'm saying, hey, I only want to pay 40 cents. I don't want to pay a penny more. So that means that when price moves up to that stop price I just set at 40 cents, assuming it hits there, it may not get there. And if it doesn't, by the end of the day, my order is automatically canceled. But if it does make it there during the day, intraday, it will then trigger the stop price, the line in the sand. And then if price stays at 40 cents or comes below that, it will put me in and buy at that price. But it will not buy me at anything higher than 40 cents because I don't want to pay up for it. I want to pay 40 cents or less, but only if it's got momentum. That's how you would do that type of order. But there are many different stop limit order prices that you can use, but this is the one I'm using in this example. So I go continue, and as you can see, it puts in the order and then it wants the number of shares. I'll just say 5 shares, and that's going to cost me $2 if I get filled at the 40 cent or better. Swipe up. See how simple it is? So let's go ahead and view the order. There's the order, 5 shares, stop price 40 cents, limit price. Now something to note here, if I wanted to say, hey, I want that price to go up to 40 cents, but I don't want to buy it no 40 cents. I don't want to buy it at no 37 or 36 cents. I want to buy it if it hits 40 and then it drops down to 35 cents. Now it may or may not do that, but that would be sort of like a classic breakout stop limit buy type of order that a trader would use if they're playing this sort of game of buying breakouts with momentum. There's many other order types that you could use outside of Robinhood that Robinhood doesn't have that you can place that will help you do that, but in Robinhood, this is how you would do it. Let's go ahead and cancel that order, and I'll show you how to do that. All right, so we need to cancel that one. So let's go ahead and do that order I just discussed. It's a stop limit order, and it's playing for a breakout. Okay, the stop price is 40 cents. Let's just say that is the resistance that it needs to hit in order for me to take a shot at it. So 40 cents, and then the limit price, I'm going to put at 35 cents. So do you understand how that works? So I'm telling it that the line in the sand is the stop price of 40 cents. If price is below it and it hasn't gone up and touched that stop price, nothing happens yet. But once it hits that stop price, then the stop limit order has been activated because it touched that 40 cents, but it will not do anything but kick in the second part of that order, which is my limit price order to buy. But guess what? My limit price, I only want to pay 35 cents or less. Okay, so that's how this particular order is working. It's used for a momentum play. So as you can see, we can continue. I won't do that. So there you have it. You've got the market orders, which are the buy in dollars, buy in shares, your conditional orders, which is limit order, trailing stop order, and stop limit order. Now, there's many ways to play some of these, and I'm not going to go over all of those options, but I think you get a pretty good idea of how you can use each one. Just remember, if you're buying fractional shares, conditional orders will not work for you. You cannot possibly in any way, shape, or form get it to work for you. You'll have to use a market order, which is up here in buy in dollars, or you use buy in shares. So really, there's no reason to be buying so many shares. It's so much easier to just buy in dollars. Now, when I trade, it's just the opposite of that. I don't use dollars, I use shares because I have lots of money at work, and 100 shares minimum is what you're going to need to get your order into the market and either be hidden from the market orders or at least be something that can be executed against, because if you go with less than 100 shares, you can get executed, but they can always see your price. And I use hidden orders from time to time. So 100 shares is minimum for a trader, but for an investor using fractional shares, you should only be using dollars. And in fact, you should probably be using dollars all the time. Don't mess with shares. You want to use risk management first, and that's really where you should be with this. So just a quick recap of what we spoke about, look at the screen, market orders, buy in dollars, buy in shares, just buy in dollars. Use risk management with how much capital you're working with, so much easier. But remember, if you're using fractional shares and buying and selling in fractional shares, the market orders are the only things you can do. And quite frankly, those are pretty tame when you're doing fractional shares. I mean, it's not going to be costing you much money. Even if you had one share of Amazon, it wouldn't be costing you much if you were paying the difference of the spread between the bid and the ask. That's called slippage. Not a big deal. You have to be trading whole shares to use conditional orders. The limit order is one that you would use because you want to pay a certain price or better. You don't want to pay a worse price. That's why you'd use a limit order. A trailing stop order can be used in a few different ways, and that would be by a percentage or a dollar amount that you want to trail the current price of that stock, and then you want to buy if it hits that percentage or dollar amount. Simple as that. And then you put a limit order behind that as to what price you're willing to pay or better. And then the stop order is essentially to get you out of a stock if it's not going in your way. And a stop order is essentially a market order. So if it hits that stop price, which is the line in the sand, it'll immediately send you out to the market and then fill your shares. It's all about speed, not price. If you want to use a limit order, it's all about price and not necessarily speed or even getting executed. You want to get executed, not in the bad way. Execution in this sense means your shares are getting filled. And last but not least is the stop limit order. Stop limit, just think of the stop as the line in the sand. If price hits that point, then that's going to open up the second part of your trade, which is the limit order part. And then that says that you want to get filled at that price or better. Most of you are just going to use a limit order. The other order types are nice to use in certain situations. If you want to put a stop behind your prices to, let's say, hey, I bought a stock at, let's say, $100 and I want to get out if it drops $5. Well, you'd use a stop order with that, meaning the stop order is $5 below your purchase price. And then if it hits that stop line in the sand, it's going to send you out in the market and immediately get you out at market prices. But market price is not always the best. But if you want speed and a guarantee, then that's the one to use. If you want to go ahead and get yourself another type of stop order to protect your profits or losses, the same thing can be said for a stop limit order. But a stop limit order, you go ahead and put the stop at $5 below that purchase price, like we just discussed in that example. But instead of sending you out in the market when that stop price, which is a line in the sand, gets hit, your limit price then becomes your maximum of what you're willing to take or better for that loss, if it's a stop loss or a stop limit order to limit your losses. So that should give you a basic primer as to market orders and conditional orders within Robinhood and help make the right trade at the right time for the right price and the right stop order. It's very simple. If you have any questions, leave them in the comments. I'll be happy to answer them for you. If you want to do further research, of course, you can just go to Robinhood. I'll leave some links below for you. Thank you so much for watching. Join the conversation below. And remember, it doesn't matter where you start in life. If you set a goal, have ambition and persistence, you can achieve most anything. Do yourself a favor. Get started today. Support the channel. Give this video a like, subscribe, ring that bell, and I'll see you next time.